SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, Sean Smith here, Managing Partner at Search Fund Ventures and CEO of SMB Investor Network. And today I'm joined by Caleb Basile, who started his own quality of earnings CPA firm, and he's been ramping up, doing lots of quality of earnings in the search fund, small business acquisition space. And before that, he was at larger firms doing the same thing. So he's an expert on financial diligence, and he's going to talk to us a bit about revenue quality, cost structure, and working capital. Caleb, I'll let you introduce yourself.
Thanks, Sean. I really appreciate it. I've been an accountant for 10 years, and I've been doing acquisitions for 5 years. I left Baker Tilly 3 years ago to focus on doing QoEs for the mid-market and lower market deals. I pride myself in being able to do a buy-side due diligence in just 2 weeks. We've done 10 this year, did 57 last year. We're trying to hit 100 this year. A little behind, but we're to do what we need to do to get 100 deals done this year.
Very nice. And when did you kind of start going out on your own and doing quality of earnings versus working at a larger firm?
Good question. So I left Baker Tilly 3 years ago, and I wanted to stay on the mid-market deals, like keep doing the large deals, but I knew I couldn't sell them myself. So I would do the entire deal on behalf of other larger firms, hence the name QoE Prep. I'd prepare it for them, and they're like, oh, well, you can do the adjustments, you can do the network and capital, you can do the whole thing. Why don't you just do the whole thing for us? And I'd charge them a percentage of their total fees rather than billing them by hour. I wanted them to know exactly what they'd pay me. Plus, it was convenient for me since I work pretty fast to charge a percentage rather than be paid per hour. And then I realized, wow, they don't really change my work too much, and clients keep asking for me, partners keep wanting to work with me. Maybe I should just start my own thing. I'm not the type of person that wants to go out and make a sale, or like the Wolf of Wall Street type of person that's gonna be like, yeah, you need to use my firm. But I know that my quality of work speaks for itself, and that people return to someone that did a good job for them.
Something that both business buyers and passive investors can always benefit from understanding a bit better is revenue quality. And I think I'd love to hear from you, Caleb, is how do you think about revenue quality just at the highest level, whether it's a service business, manufacturing, consumer products? What are the key things that define the quality of revenue for a business? And then we can drill in a bit more for specific industries.
Sure. So the first thing is the revenue there? I'll check all the bank deposits and all the revenue per the financial statements and make sure that the revenue that they're saying is going in the company is actually going in the banks. The second thing is revenue concentration. How many customers do they have, and how much of a risk is there if one of their larger customers leave? Another thing is recurring revenue. Are their customers one-time revenue customers, or are they is it on a subscription model? It really depends. The more recurring business you have, the better. Another thing I like to think about is revenue per salesman. So when you're buying a small business, a lot of times the owner is the one making all the sales. For my business, I make 100% of the sales. It'd be hard for me to sell my business because someone had to replace what I do. So if the owner makes most of the sales, I say that's kind of a risk, especially if it's not recurring revenue. Because just because you can own and operate a business, it doesn't mean you're necessarily a salesperson. It takes a while to be able to get those skill set to where you can replace the new revenue coming in if it's not a highly recurring revenue.
Yeah, it's interesting to hear you talk about revenue per salesperson or kind of that key relationship owner as a quality of revenue item. That's something we don't think about as frequently. Segment that into, call it key person risk or something different, but it is a great point, right? That at the end of the day, customer concentration is frequently viewed as a revenue quality item, right? So why isn't concentration to a specific salesperson similarly considered a revenue quality?
It is in my QoE reports. And then you want to see, how do they bill their customers? Are they billing up front? Are they billing at the end? Are they billing over time? So depending on each industry, you want to look at that to make sure that they're not recording too much revenue in one period and too little at another period. Because you're supposed to record it on an accrual basis, which means I record revenue when I earn it, not when the money hits my.
And that's a really important topic in and of itself, right? Revenue recognition policies. Are people looking at cash accounting versus accrual, to your point? So that's probably a little outside the scope, but just to drill in on some of these items. So what is kind of the sliding scale that you see for something like recurring revenue? On the one hand, I'll tell you how we think about it, right? On the one hand, there's purely one-off project-based stuff that comes from customers that are brand new and never come back to purchase again. That's like the full low quality end of the spectrum. On the high quality end, there's customers who have long-term contracts in place that have been customers of the company for many, many years. And there's kind of even teeth in those contracts for cancellation or termination or things like that. So how would you kind of chunk up that spectrum?
Yeah. So what I do is from QuickBooks Online, I'm probably giving away too much, but I'll download customers, the revenue per customer per month. And you can see what the revenue is for each customer for each month. And then I'll sum it up by each year. And then I'll show whether the customer if the customer stays from 2022 to 23 to 24. So I'll show like on an annual basis, how often do these customers come back? And then on a monthly basis, I can show like, are they paying every single month? Are they paying every single quarter? Or is it once a year? How recurring are these customers?
You look at the QuickBooks Online outputs, or do you get into the bank statements themselves and even the contracts to determine whether or not there's truly kind of recurring nature? Where do you kind of end your analysis?
So I look at the historical stuff. So if I'm seeing money from each customer going in every single month, I know for a fact that that's going to be recurring. I don't really go into the future and look at like what their recurring contracts are unless if it's like a high concentration, like above 10%.
Got it. And then when it comes to things like backlog or work in progress, how do you diligence those sorts of items?
So a real easy rule of thumb test is you want to make sure that the profit margins are pretty much the same month over month. They're going to be very wacky depending on how people bill and record stuff, but they should be similar. And then I'll look at their work in progress reports and I'll make sure that based on what they earned. A lot of times it's based on cash, so we have to recast revenue and make it based on when they earned it. So it can be, if it's like a manufacturing company, it could be they could record revenue over time. They could record revenue based on a cost budget, or they could record revenue based on labor hours. There's different ways of recording it. I just like to get from the seller how they record revenue and what do they do when there's order changes, just to make sure that they're recording the right amount of revenue in each period. A lot of times you'll see December either going really, really high or really, really low. If it's going low, it's for tax purposes. If it's going high, they're trying to sell the company.
That's great feedback. And looking across some of the business models across the industries you mentioned, how do you look at things differently for, say, a services business versus a manufacturing business? One generally is probably more kind of PO based, whereas another might be more contractual or project based. So how do you kind of think about those different business models and then ultimately kind of compare revenue quality on an apples to apples basis?
Yeah. So I try to get everything on an accrual basis when they earn it. For like an accounting firm, legal firm, insurance company, those are pretty easy. If they're based on the cash basis to accrual basis, should be pretty close. Construction company, that's when those always are a little bit more tricky because people just record revenue on a cash basis and you have to go back and make sure that we are showing the right amount of money.
Yeah, that's also where I think that the work in progress and backlog gets really important, right?
Another thing that's important to look at is accounts receivable and bad debt expense. So if there's a lot of bad debt expense, then a company is over recording revenue. And just because you bill out $100 doesn't mean you're going to get $100 back. You might be getting 95%, 90%. Or if you're in the health industry, you might be getting 85% back because no one pays your health bills. Kind of strange, but it's just the way the things are. So people don't pay health bills a lot. So if they're recording their AR at what they're hoping to get, then they're over recording revenue. They should be recording it as a percentage of what they normally have been making. So that's an adjustment I'll commonly make.
Very helpful. So why don't we jump into kind of a second topic here, which is working capital. There's lots of kind of warnings out there for buyers that don't put enough working capital into the business at close. But how do you first look to identify the right kind of target working capital for the business? And then what would some pitfalls be to make sure that buyers don't fall into and that investors can watch out for?
So I'm going to talk about the two scary things of working capital. One is you're taking on more current liabilities than you should be. The other is you're taking on less accounts receivable than you should be. So let's say I'm going to sell my company in 3 months. I have all these bills coming in and I decide I'm not going to pay any of them. Why? Because I'm selling my company. It's not my problem. It's the new owner's company. So a lot of owners try to do this. And what establishing a net working capital peg does is it prevents an owner from slapping you, the buyer, with that liability. Another thing I've seen is they try to collect really, really, really fast what they're about to sell. They're like, oh, I've earned this money. I got to get all the money in my bank right now. So they'll work really, really hard on collecting all the accounts receivable so that they can have all the money that they've earned in their pocket. But when you sell, imagine a car. When you sell a car, you got to leave it with some gas so that new buyer can at least drive it off the parking lot. As a part of the purchase price, we will establish a net working capital peg, which basically means there's enough current assets and current liabilities to where like the company can still run itself for a little bit. So we establish that peg, that net working capital peg, and if it goes above, if the buyer leaves you with more, you pay a little bit more. I mean, if the owner leaves you with more, you pay a little bit more. If the owner leaves you with less, you get a discount. Now, funding your net working capital or getting an extra loan for your first months, that's more of a loan question or like a question for the bank rather than for the purchase price. But for the purchase price, that's what the net working capital peg does.
Yeah, and that's helpful. I think the topic to really highlight for passive investors is when there's not enough working capital, which ultimately puts the company in a position where it's not bringing in enough near-term cash to fund operations. That's the key concept, right? How can people peg is structured in a way so that there's not a risk that the company doesn't have enough working capital to fund operations? Because we've seen plenty of quality of earnings reports that are great, prepared by great folks, and they'll use a trailing 12-month peg. But to your point, the past 6 months, or maybe even more than that, seem to have way lower, days sales outstanding than the past 3 years, implying maybe someone's collecting a little more aggressively or something's going on, right? Something changed versus historic periods. So now, if you calculate a peg off the past trailing 12 months, but those past trailing 12 months have been a period where collections were rapid, and to your point, liabilities were also slower. Those days payable outstanding were creeping up. What can folks look out for to make sure that's not happening?
You just make sure that it's not trending crazy high or crazy low. So based on a chart from the past 12 months, that'll help out. Another thing I like to look at is seasonality. I like to know, is the buyer going to come into a time where he's going to make a lot of money, like 40% of all the revenue in one quarter? Or is he coming into a time where they're not going to make a lot of money? It's like a landscaping company in the Northeast. You're going to make 15% of your total revenue in quarter one. So that has some implications because if you have a lot of salaried employees, you still have to pay them the same amount. Your expenses are still pretty high, but your revenue coming in is going to be lower.
Yeah, so that's a really interesting point. If you're considering buying a company or investing in a deal where the seller's pushing to close ahead of summer, and summer is when they earn all their money, how should investors or buyers think about that, both from a working capital standpoint and potentially from just revenue coming in?
Definitely need to be aware. A seller is more motivated to push after they've had their nice big busy season and they've collected all that. A buyer is going to be a little less motivated too, because you want to buy when the money's coming in. That might be a little adjustment to the EBITDA multiple. It might be something where you say, hey, let's just wait 6 months, let you ride out the hard period, and then I'll buy it in 6 months. But then you have to be sensitive to the LOI exclusivity. So it's just something to think about. Like there's not one right answer to it.
It's very interesting. So we've talked about revenue quality. We've talked about the importance of working capital, how to get that peg right. What about getting the cost structure and getting a really good picture of that cost structure? So when you think about diligencing gross margin and then diligencing to what you just mentioned, some of the more kind of fixed expenses, how would you go about identifying the quality of that cost structure? Is it more variable? Is there a lot of operating leverage? How do you think through those things?
Are you talking about the cost to run the company?
That's right. So
Gotcha.
variable costs versus fixed costs.
Yeah, good question. So on the cost of goods sold, you want to make sure that their margins aren't getting worse and worse. And you can do it by looking at the numbers, but you can also do it by asking the owner, how do you price your items? How often do you change your pricing? Because if the revenue is going up year over year, but margins are going down or profit is staying flat, like they're not able to effectively price their products onto their customers. And then you can break it down by looking at the expenses, fixed expenses and variable expenses. So the variable expenses, they should go up at the same percentage of revenue. The fixed, you want to make sure, like one of the biggest one is always going to be rent or your lease. You want to make sure that the lease isn't going to go, if it's going to go up, you want to know what it is. And if it does go up, you want to press that into the QoE. That the rent EBITDA adjustment is pretty common. If the current owner owns the land and he's going to rent it out to you, make sure you get that settled what the price will be in the LOI. Employees, you want to make sure you have enough employees to keep up with the demand of the increasing work. Ideally, you're buying a company that's trending up and not down, or you want to make sure that you have enough capital to hire the right talent. I look at expense by vendor and I make sure that there's no, so in addition to like revenue by customer and expense by vendor, you want to make sure that there's no related parties or handshake deals going on, that there's some discounts or some family relations that's changing things. Because like in these small deals under 5 million, that's going to happen a lot. And you want to make sure that if you have a supplier that's bringing you a lot of what you need, that it's not at a special discount or anything.
Helpful. So what do you do when you see a gross profit margin that isn't consistent over time, and when revenue increases dramatically, the gross margin increases as well, and when revenue declines, gross margin also declines, right? That means it's probably not variable, and it's not actually a real gross margin figure. So how do you kind of drill into things like that?
Yeah, so a lot of the times it's just people don't know, like if the revenue is going up by a lot, but the gross margins are going down, then they're not pricing things right. They're not pricing things right. So you want to ask about how they're pricing things.
We'd seen just misclassification of expenses, right? So a lot of times folks just don't have the right systems in place to say, hey, especially with businesses that are service businesses where a lot of it's about time tracking, right? They just aren't effectively allocating direct labor versus non-direct labor. And everything's just kind of sitting in either that gross margin line item, or sometimes it's sitting below that gross margin and it's actually, it should be a variable cost. So that's
as
one
part
that
of
we
my
think of.
as part of my QoE, I reallocate things. So I don't go with what the QuickBooks says their chart of accounts are. If I think it's going to be a cost of goods sold, I'll reallocate it there. So that kind of makes people more aware of what they should expect their COGS to be and what their operating expenses should be. Another reason could be inefficiencies. As you grow bigger, ideally you should be getting more efficient and better trained people. But sometimes when people grow, employees become more inefficient and it's hard to keep your margins high. So if it's a new company, margins might start at 60%, but then it goes down to 40%. And you want to know when it has stabilized. So that's something to keep in mind.
That's a good one. And that probably relates predominantly to services-based businesses where maybe you hire really good ability to hire some great folks in the beginning. And as you scale it up, it gets harder and harder to find great talent. Would you see that same sort of dynamic in a business like distribution that's more hinged on materials or products as a cost of goods sold?
Yeah, no, it won't be as, I mean, ideally it shouldn't be as bad, but well, maybe because if they're getting bigger customers, those customers are asking for a bigger discount from their pricing. So they can't mark it up as high. So that could be true for those type of businesses as well. But yeah, to your point, it is definitely more common in people when the people are the cogs rather than materials.
That's a good one. It's interesting to see how these ratios and these indicators of quality that folks like yourself honed in on in the quality of earnings report can differ across various business models. The business model itself has such an impact on how you think about changes in gross margin. What are those value drivers behind it? So it's critical that folks like yourself call that out in their report. That's what us investors look for.
And it's really good to look at gross margins. I'll leave you with one funny story, or not funny. Thankfully, I saved the client from this. But there was a buyer was going to buy a company in the fitness. It was like a fitness center. So you pay monthly recurring subscription model, $100 a month. Before the seller sold the company, he changed from monthly to annual, and he collected all the money. So the new buyer was going to buy the company, without collection for a while from a lot of the customers. I caught that and it prevented it from happening. And
Yeah,
then the deal. Yeah. And
yeah,
then the deal died because the buyer and the seller didn't trust each other. But he just collected all the money up front. The customers weren't going to pay for a year.
yeah. Well, that could have been a disaster. Anything you want to close out with? Tell the group about?
Sure. So my company at QoE Prep, we pride ourselves in getting a buy-side quality of earnings done in 2 weeks. We are super responsive. We're super helpful. If you have any questions, feel free to ask. If you just want to meet my team and see if we'd be a good fit for your acquisition goals, reach out to me at caleb@qoeprep.com and we can book a meeting there.
Great. Caleb, thanks for the insights on this call, and look forward to hopefully reviewing some of your QOVs as we consider investing.
Sounds good. Thanks, Sean.